Hey everybody, welcome to my channel. Hope you guys are all doing well today. With BitMEX going down and Durbit now requiring KYC, we currently have a void in the space with many traders out there looking for a non-KYC platform that allows them to leverage trade or hedge against their positions. There's a few DeFi projects that just launched within the year that are well positioned to absorb some of the market share. They have a few things working in their favor. Currently, DeFi is a major trend, so there's investors out there looking for opportunities. And additionally, it made it a lot easier for them to raise funds. And secondly, with the price of Bitcoin rising and seeing a lot of mainstream interest start to pick up, options volume for Bitcoin and Ethereum across many venues have been on the increase. And lastly, like I mentioned earlier in the video, you have BitMEX that just went out, and now you have Durbit enforcing KYC by the end of the year. With all these forces converging, I don't think there could be a better time to start a DeFi project focused on options trading. And in this review, I'm going to focus on three projects: Hegic, Hedget, and Opyn. But before we dive into this review, I want to quickly ask you guys to consider joining my Discord channel. If you want to join a community of diverse crypto enthusiasts who talk about CeFi, DeFi, and other crypto related industries, I welcome you guys to join my Discord channel by clicking the link in the description below. And I also supplement all of the work I do here on YouTube with a newsletter. If you're interested in getting industry related news, update on interest rate changes across various DeFi and CeFi platforms, and occasionally I'll even let you know what kind of moves I'm making in my own portfolio. You can get all that and more by subscribing to my free newsletter. All you need to do to sign up is click the link in the description below and enter your email address. With that, let's go ahead and dive into this video. Alright, let's kickstart this video by talking about Hegic. Now, this video isn't intended to be a comprehensive review. I'm just going to give you guys a light overview of the various options trading platforms. Hegic recently had an initial bond curve offering in September, and at that time the token sold for approximately 13 cents a piece. The platform is currently operational. You guys can come over here and buy a ETH contract if you guys wanted to. So for instance, if you were bullish on ETH, you would come down here, click on ETH, click on call, select your option size, the strike price, and the period of holding. All the parameters that determine the total cost and the break-even price have been programmed in. So all you really need to do is connect your wallet, decide how much you want to trade, and scroll down here to purchase the contract option. And it's a little bit different from traditional models where you have a writer, which it typically ends up being the house, or in other DeFi models, you have individual actors as writers. Hegic is unique in that they've deployed a bi-directional AMM pool, or automated market maker. So essentially it pools funds from liquidity providers who collectively act as the house. Now, a big pro to doing that is you can socialize the losses, but a major risk is that if you have too many winners in a very short period of time, the pool could have a significant portion of the funds drained. But I think what's going to happen over time as more people get involved in the development of the protocol, you'll see third parties or members of the community build hedge product to help preserve the liquidity locked into the protocol. But generally speaking, the house tends to win on a longer time frame, and the hope is to build even more products on the platform to make it easier for market participants to hedge. And in that setting, you'll get a lot of people who use the platform whose contracts end up expiring. So even if you have a lot of winners, people hedging and also the losers, in theory, should cover all the losses incurred by winners. Now, the interesting thing is that in the white paper that was published earlier in the year talked about governance, but in all the recent documentation, there's absolutely no talk about governance. And if you go visit the Discord channel, I've gone through a lot of the comments and I've never heard anybody discuss it. In my view, I think in the long run, they'll have to implement governance at some point. But for the time being, I can't tell you when this is going to be implemented or if it's going to be implemented at all. And if you're interested in buying the Hegic token off the secondary markets, the platform does have a token if any of you guys are interested in getting exposure. You need at least 880,000 tokens to secure a lot independently. Or if you don't have enough Hegic tokens to have your own lot, you can actually pool your Hegic tokens. There's one project that's already been deployed and two in progress. And once those are deployed, you'll have 3 options for staking your Hegic tokens. Anytime somebody purchases a contract, there's a 1% settlement fee, which is in addition to the contract fee itself. The contract fee goes to the LPs, the settlement fee goes to all lot holders. But let's say you don't want to spend any of your Bitcoin or your Ethereum because you think there's some significant upside in the short term. Another way for you guys to accumulate free Hegic is by being a liquidity provider or trading some options. And if you provide liquidity, you'll be given our Hegic tokens, which is basically a claim on Hegic tokens when they're unlocked. And since the LPs are taking on most of the risk, their share of the rewards are going to be much larger than options traders. And if you decide to be an options traders, one idea would be to open a long and a short position at the same time. This way they sort of offset each other and potentially you could even be profitable. And while you have those 2 positions open, you'll also be accumulating our Hegic. So in other words, the fees that you're paying are basically going towards purchasing our Hegic tokens. But before you guys commit to anything, make sure you guys thoroughly read the Medium write-ups. I'll link one of them in the description below. Because, for instance, to be a liquidity provider, it requires you to lock your tokens up for a 14-day period. And obviously, you want to take that into consideration before you decide to provide any liquidity. And as I stated earlier, our Hegic tokens are a claim on the actual token. And if a certain scenario plays out, you may not get the tokens until the end of next year. And before moving on to the next project, I do want to point out that the project has been successful in bootstrapping $16 million worth of liquidity despite being a very new project. Moving along to the next project, Hedget. Unlike Hegic, they didn't do an IBCO, they did an IEO. The average token sold for approximately $7. They're also backed by a lot of VC capital. They're a little bit different than Hegic because only a portion of their activity is going to be directly on Ethereum. The protocol is only using the Ethereum chain for settlement. All the other activities are going to be done off-chain on a different layer. And from the beginning, they have composability in mind. For example, by using this protocol in Compound, you could avoid liquidations. You can achieve this by giving users the ability to buy a hedge option. So when they open a CDP, they can pay an additional fee to protect themselves against a liquidation event. And they're still in their early testing phases. They haven't launched the beta version of their platform yet. If everything goes well, you'll probably see it come out in the next couple months. Another way they differentiate themselves from Hegic is that they've fully disclosed the names of the team members. This way, any of you guys that are looking to potentially invest in the project can fully vet the team before deploying any of your funds. Now with their token, you're not going to be eligible for any of the fees that are generated by the platform. However, you are going to be able to participate in governance proposals. And as a user, you're going to need to own Hegic tokens if you want to trade on the platform. And lastly, this is kind of similar to Hegic, but to help bootstrap liquidity, they're going to incentivize LPs by giving them Hegic tokens. And based on what I've read from the white paper, it looks like their model is going to be somewhat similar to Opyn's model. They're going to have takers and makers, but unlike Opyn, they do have a DAO model and a token. So a good portion of the fees that they generate will go into a reserve, and the community will ultimately decide how those funds get spent. Unlike Hegic, which charges a 1% settlement fee, Hedget is only going to charge 0.02%. And in the first 3 to 4 years, users of the platform won't have to pay this at all. In fact, the system is going to pick up the cost by paying writers from the liquidity mining pool. And if you accept the premise that the token represents equity in the protocol, then essentially what they're trying to do is bootstrap user activity by reducing fees and then compensate LPs by giving them additional equity in the protocol. Lastly, we're going to talk about Opyn. Unlike the previous 2 platforms I talked about, there's no token associated with this platform, and it's purely funded by VC interest. And when you come to the platform, you can do 2 things. You can buy protection or you can sell protection. So in other words, if you're looking to long or short the market, or perhaps you're looking to hedge, then you want to buy protection. And if you're looking to write the contract and get paid for doing so, you're going to be selling protection. Just to illustrate how this works, let's say you were interested in being a writer. You would click here on sell option. And let's say you were fairly confident that by December 25th, the price of Ethereum wouldn't trade below $360. You would go ahead and click on that contract. And here on this page, you would have to pledge a certain amount of USDC as collateral. And if the option is exercised, you'll be obligated to buy Ethereum at $360, no matter what price of Ethereum is trading at the market. Meaning that if Ethereum is trading at 300, you would still be obligated to pay $360 for it. But if the price doesn't go below $360 and the option never gets exercised, in that case, you basically got this premium here for free. And the premium here is paid to you up front. So as soon as you provide the collateral, you're going to be paid the premium and it'll go directly into your wallet. So if you put $1,000 worth of collateral in, $64 worth of Ethereum are going to go directly into your wallet. If the contract gets exercised, the collateral that you provided will be converted into Ethereum at the rate of $360 per Ethereum. If the contract doesn't get exercised, you'll basically get your collateral back and you'll be able to walk away with that premium that you made. Also, unlike the other two platforms, you're not limited to Ethereum and Bitcoin. You guys can trade in other assets like Uni, Wi-Fi, DAI, and they're planning to add more assets in the future. Even though this project has been deployed longer than Hegic, they've only accumulated $2.1 million worth of liquidity. It took a big hit in March when there was an exploit that was found. About $400,000 was taken away from the protocol. They eventually were able to get all the funds back, so nobody really lost any money. And since the hack, they've actually acquired more liquidity, more money has actually flowed into the protocol. And this really just illustrates what kind of risks are involved in DeFi. Despite having this formal audit by a reputable firm, Open Zeppelin, they were still exploited. Now, the downside to this platform, especially if you're bullish on it, is that there's no token. There's no way for retail participants to get exposure to the protocol. And getting started is very easy. All you need to do is connect with your wallet. They didn't require me to enter in any of my personal information. And if you know what you're doing, you can literally write an option in less than 5 minutes. Now, to wrap this video up, I created this chart for you guys to consolidate all the information to make it a little bit easier for me to summarize things for you. Now, the team for Hegic is anonymous. Project lead or head developer has remained anonymous. I mean, he or she did one interview on Defiant, but it wasn't a video interview, it was just a written interview. And so it's really difficult to get character insights. You don't know if this is ultimately going to be a rug pull. And that happens to be the biggest risk that you're taking with this project. At some point, this anonymous developer and his or her team could just run away with all the funds. And to date, I haven't really heard of a successful model that's worked out where you've had a lead developer or a head of a project being anonymous. But I mean, we do have one really good working example of this, and that's Bitcoin. To this date, nobody knows who created or started Bitcoin. And I think it's fair to say that Bitcoin has been wildly successful to date. But I think in the DeFi space, this is probably going to become more commonplace. We just need one good working example of this, because ultimately, if a protocol is going to be decentralized and autonomous, you really can't have a figurehead or a leader that law enforcement or a regulatory agency can take down. Now, in terms of liquidity, Hegic clearly has the lead, even though Open's been around for longer. Hegic actually used most of the funds that they got through the IBCO to inject liquidity into their bidirectional AMM. And they also have pretty robust incentives for people who provide liquidity early on. And the problem with Open, in my opinion, is that they rely on a lot of individual players, which is great because now we finally have the opportunity to act like the house and make a little income off of writing contracts. But until they figure out a way to generate more liquidity, I think it'll be a challenge for them to onboard new users. And out of the 3 projects, there's only 2 projects that have token, Hegic and Hedget. And in terms of governance, Hedget definitely has a plan to implement a DAO. With Open, they have private investors and they don't have a token, so I don't see this happening, especially in the near term. And with Hegic, I didn't see any recent documentation talking about governance, but I think that's eventually coming. They did briefly cover it in their white paper. Now, in terms of profit share, if you buy the Hegic token and you pool Hegic tokens into a lot, or you own a lot yourself, the protocol charges 1% in settlement fees. And by owning a lot or a portion of a lot, you'll be entitled to some of that revenue. With Hedget, most of that money goes towards the DAO, and then the community votes on how to disseminate those funds. And with Open, we've already discussed how you can make some money. All you need to do is be a writer for a contract. Now, in terms of composability, all these projects are essentially Ethereum-based projects, and they're all building with composability in mind. If you read some of the documentation, you listen to some of the interviews, it becomes abundantly clear that they've thought of other use cases than just simply doing options trading. Now, when it comes to KYC, I think for the most part, you're not going to be required to do it unless there's some sort of regulatory changes. But the problem with Hedget and Open in the long term, in my opinion, is that you know who the faces are, you know who's behind the project, you know who the founders are. So if any regulatory body out there decided that they weren't compliant, they could easily shut down Open or Hedget. But with Hegic, since you have an anonymous team, that's going to be a lot harder to do. And I think it's going to be very interesting to see how all of this plays out, because right now DeFi is in its very early stages. There's not a whole lot of value locked into it, but as these protocols iterate and they get bigger and you see more value locked into them, regulators are inevitably going to turn their eyes to them. And that's when we're going to learn if having an anonymous team actually works. Because if the regulators decide to crack down on DeFi protocols across the board, you're going to see some dislocation. Because I'm thinking that initially a lot of people that are providing liquidity, they're just going to pull their funds out. Some protocols are probably going to get wrecked, but I think some protocols are going to be resilient enough to survive that liquidity exodus. And after that hypothetical crackdown, if DeFi protocols survive, in my view, that would be very bullish for the DeFi space. Now, if you're still listening to me until this point, it's very likely that you're enjoying what I'm talking about. You're enjoying my insights. If you're interested in getting more exclusive content, getting access to my private Discord channels, you should consider checking out my Patreon page. By signing up for the higher tiers, you'll be able to engage in one-on-one dialogue with me. And if you end up choosing one of the lower tiers, you'll get exclusive video content, written content, and of course, access to my private Discord channels. If any of that intrigues you, I highly recommend checking out my Patreon page by clicking the link in the description below. With that being said, this is CryptoOneStop signing out. I'll talk to you folks next time.